Well, thanks for having us, because this is a pretty exciting forum to be supporting, so very, very stoked to be involved. Very short ditty about LegalVision. So we are a full-service commercial law firm. You'll be surprised how many times I get asked that question, but yes, we do law. We primarily work with our clients on a subscription basis, which is our big differentiator. So the idea is obviously fixed monthly fees, and regardless of workflow that you send our way. So we are obviously a business ourselves, so the only way that we can make that work is to have a really heavy focus on tech and AI. So we've got a team of developers that have basically built our own tech stack. They're integrating AI models into that and training those AI models. So it's pretty exciting to be part of a business in a very traditional, slow-moving profession and trying to shove it in the right direction.
Thank you, and thanks for the support.
Pleasure.
Right, so what's this session about? Like in the last session, we heard from Luke and Jason, and what we're going to do now is we're going to delve a little bit deeper into Jason's transactions. So lucky he's here to fill any gaps that these guys have along the way. But this is the team, well, not all of the team, but some of the team that supported Jason along his search journey and then into the transaction and through completion. And so one of the really important things that you've heard already from Luke and Jason is how important the support network is, both from the investor group and also the advisor group, for the entrepreneur going through this process. There are a lot of people that come to EtA as an entrepreneur that have been in PE or investment banking or finance or accounting or law and have been involved in these types of transactions. But it's very different to be in the seat doing it. And so to have great experience around you is really, really helpful. So we've got Georgina and Craig and Jake up on stage. And Georgina has just introduced herself, obviously, as the lawyer in the mix, because they do law. Craig, what was your role in this process?
Thanks for that. Yeah, so my role was, because this was a trans-Tasman deal, I was working alongside financial due diligence team that was primarily based out of Australia. And I was called on to help kind of deal with the tax due diligence on the buy side for this particular deal. So my background is I'd been a partner at EY for 25 plus years and had focused on entrepreneurs and family-owned businesses. And so I was able to step in and help the Australian finance due diligence team to kind of work out on the New Zealand tax side of things on a cross-border deal.
Yeah, fantastic. And given what we want to see even more so in the interplay between Australian and New Zealand transactions, I think that understanding those cross-borders is really, really important. So it's good to have that experience. Jake, what was your role in this team?
I've been running and working with search funds for about 13 years and currently run a company called SMEVentures, which is a platform accelerator for search fund entrepreneurs in ANZ. Had the pleasure of working with Jason throughout his search through the deal and now sit on Jason's board. Fantastic. Excellent. I had a very small part to play. I provided a little bit of the capital, but that's about it so far. And the spiritual inspiration.
Right. So what we're going to do is let's just walk through the steps of this journey. And what I want to try and dig into is just the nature of the interactions between these guys on the team and Jason, because I think it's definitely a team game, as anyone will say. So to give you an understanding of how they get involved in that process. So during the search, Jake, you were the first of the support crew on board. What did you focus on with Jason in the first few months of the search to get him started? Like, what does that first 3 to 6 months of the search phase look like in your support?
So through anecdotal observation and some studies run by people in the global search fund and EtA community, success of the search is highly correlated with just the quantity of opportunities you unsurface during the search, and that is a function of the volume of outreach that you do and the quality of that outreach. So that is a big focus, particularly in the early phase of any search that we launch with the entrepreneurs that we partner with. We have a very strong engine that we've built over the past 5 years and a good team that helps us do that. So just to give you an idea, over the course of Jason's search, he reached out to over 10,000 businesses, heard back from over 3,000 of them, and spoke to 800 or 900 of them. So a very, very large funnel, and that has several knock-on effects. One is it just maximizes the opportunity that the chance that the right opportunity is going to come across your desk at some point. But equally as important, it builds confidence in the entrepreneur to keep the bar high and say no to things that fall below that bar. So that's a big part of it. And through our model, I get to work very closely on an almost daily basis with the searchers that we partner with. So it's in an otherwise lonely adventure. We can turn it into more of a partnership in which one of the partners has some experience.
Fantastic. And just to put those numbers in perspective, if you were to look at across the board for Australia and New Zealand, businesses with earnings of sort of 1 to 4 million would be somewhere between 150 and 200,000. So, to hit 10,000 of them is even just still a drop in the ocean in terms of the total acquisition set. So, Georgina and Craig, we'll start with Craig and come back to you. Obviously, during the search phase, early on, you guys don't kind of step in too heavily, but as people start to see sort of early teasers or early IMs, and they're trying to assess as part of that process that Jake was just discussing, which ones to take to the next step. From your perspective, what are one or two of the things that people should look for in terms of things that are a definite no or things that are actually we should learn more?
Good question. And I know Jason would have been cognizant of all these sorts of issues as well, but it's generally looking at key sort of financial related risks around sort of customer concentration, as a business relying on sort of one key customer, is there variable sort of, revenue sort of growth in 1 year and a decline in another year, just issues where you're seeing there might be sort of concerns or problems. High staff turnover is always a good one, just trying to understand those kind of key things. And are they in an industry that's potentially declining, or is there some real good upside given macroeconomic trends? There's just a few things just to note.
Yeah, great. And Georgina?
Well, traditionally legal gets involved even later. So generally it's going to be operational and financial kind of investigations that are happening at that early stage. So I guess less of a red flag risk, and this is not a self-serving comment, but just encouraging you to engage your advisors early and as early as possible. As you'll probably all obviously know, it's a really wonderful, tight, supportive community, and that does extend to the advisors. So I think what you'll find is a lot of advisors will give you a lot of time before they try and get you on the clock. They will help you with that initial strategic kind of planning, structuring, give you some advice, connect you with the right people, and try and basically stop you diving down into the deep end before it's too late. It's obviously to the advisor's benefit as well, because then it's a lot easier and a better experience for everyone in terms of actually structuring the deal. And I guess as a main example of that is the LOI stage. Like, it's a really interesting stage, right? Because you haven't done extensive DD yet. You want to table a really good offer, put your best foot forward, but you also need to move really quickly in a competitive process. And so if you're signing that LOI and then dropping it on the desk of your lawyer, it's actually really hard. Yes, they're non-binding, but it's really hard to move away from those key commercial terms and this proposed structuring of that deal. So again, you just give your advisor a call, say, this is what I'm about to sign it. A good advisor is not going to negotiate or tell you where to place your capital letters or your punctuation, but they're going to give you that really high level advice, often again off the clock, just to make sure that you're setting yourself up for success in that deal.
Yeah, and particularly, I guess, for people that are going through this for the first time, that early advice, even just directionally, is super, super valuable. Right, so we're going to accelerate through to actually you've found your target, you're then in the negotiation phase, and we're going to go a little bit kind of in reverse order, but we'll start with Craig, actually. So one of the things that often comes up, and there'll be some opinions in this room, and given we're a nice small group, I'm happy for people to yell out if you've got any particular opinions on this next one, because I think that it's a really interesting one that always comes up. The preference from a seller's perspective and a buyer's perspective between assets deals and share purchases, and the pros and cons and the impact of that. And obviously your lens is tax, and there's obviously some implications there. But from your perspective, how do you weigh up the differences between kind of asset sale during the negotiation phase or share purchase?
Again, there'll be a lot of experience in the room and a lot of different perspectives on it. But in New Zealand, especially if you're a vendor, New Zealand doesn't have a comprehensive capital gains tax, so it kind of lends itself for them to want a very clean, simple exit by selling shares. And if they're going to be selling shares, they can walk away potentially with a tax-free capital gain. So it's quite influential for them to try and want to push for that. There's quite a conundrum, because for a buyer, they effectively they want the opposite. They effectively want to buy assets that they can get maybe a step up in the cost base of them. Effectively, if they do a sort of a purchase price allocation that allocates the value you're going to pay across various assets, so you can potentially start to depreciate assets that are tangible at a higher depreciation rate. And you're not also buying into the history and potential liabilities when you buy shares in a company. So take tax. Tax is just one cost that has to be managed, but it can be quite an expensive cost. And so, the IRD in New Zealand has 4 years which they can go back and review and revisit sort of tax positions adopted by a vendor. And so you really need to cover that risk off if you're doing a share deal by really proper warranties and indemnities. But as well, you might do, as we talked about before, there might be some sort of warranty indemnity insurance for the vendor. They could even get some binding rulings on some key issues that are really, really quite sort of technical and contentious. So I think that whole risk for a buyer when they're coming into a business, they really want to set up in a clean structure, not have the risk of the history that they might be buying into with shares. But that it's a lot more of a complicated deal, because obviously you sometimes have to get a whole lot of customer and supplier type of acceptances for doing that, and so it can be a lot more complicated deal from a legal perspective, which Georgina will probably talk about in a second. So I would say purchasers, we'd be favouring an asset deal if, as long as it's not going to be overly, complicated from a seller's perspective.
And where do we end up with Jason's one? Were we shares or assets?
So that was a share deal, because it was trans-Tasman. It was effectively just going to be easier. One, because of ease of not having to get customer and supplier consent on things, and it would pretty much have been negotiated up front that was sort of like a non-negotiable from the vendor's perspective. I think that's right, Jason, isn't it? Yeah.
So then on to legal in the New Zealand context, because we've got some Aussies here also. What are there any distinguishing features in the New Zealand legal context in terms of small business transactions that it's worthwhile for people to keep an eye on when they're negotiating a deal through to completion?
Yeah, look, I don't think it's so much of a legal question. Obviously, Craig's touched on that from, the structuring perspective, but I think it's very easy, and this kind of goes to the psychology of transactions, but it's very easy, I think, for us all to assume that New Zealand is the same as Australia. We're basically a different state to Australia. And look, in many contexts, that's absolutely true. But in saying that, and obviously deal structuring wise, what's market standard terms, all of that kind of stuff, New Zealand absolutely follows trends in Australia. So that's a really great kind of playbook that you can use. But it really goes down to the relationship piece. So in New Zealand, we, as a business culture wise, this is a broad brush kind of comment, but a little bit more laid back, more casual. We are probably not so hard-nosed in terms of our negotiating, but that's not to say that you're going to get an easy deal in New Zealand. It's going to really come down to that relationship. So that vendor is going to say, as simply, do I like you? Can I see you in this business that I've grown from scratch? It's my family business. I don't have a clear successor. Do I like you? Are you the right fit? For this transaction, Jason obviously intuitively knew that. And so he spent that time coming over to Christchurch. And, I'm from Christchurch. If you're going to get an Australian party that's interested in buying a business, you're going to assume they're buying in Auckland. So it's a very close-knit community. He, obviously showed huge commitment early on. Young family, he's going to move here, he's moving everyone over. So that's incredibly critical. From an advisor perspective, the only other thing that I think is worth touching on is in New Zealand, a lot of your advisors are going to be generalists. That's just because our market is small. You have to be a generalist, and so what I would say is, test their expertise, make sure, and obviously EtA transactions, not many of them have happened in New Zealand, so nobody is going to hold themselves out as an EtA expert, but obviously it's got all the hallmarks of an M&A deal at the small to mid-market end, so as long as you've got those expertise, then they're going to be the right fit, but do test it. And I was just saying to Jake last night, as I was walking out the door, when I was reflecting on this deal, the one sort of lasting memory was right before he engaged us, and you won't mind me saying this, but I sat in on an interrogation from Jake where he sort of dived into my background and my expertise and the team that was going to work with me. And look, I really respected that approach. I was like, here's a client, he knows what he wants to make sure that he's got the right team around him, and equally it gave me a really good insight about how Jake was going to want to work and equally how Jason was going to want to work on the deal. So it was, I do encourage you to really ask those questions and make sure that you've got the right fit in your advisors.
You passed.
Oh, look, she's still here. Jake passed too, by the way. So this next one's always fun, and I'm going to give it to Jake. So we're in the negotiation phase, right? Talk to me about working capital.
Yeah, so I was just talking with Ben from Altor during the break about why this model works and how a lot of investors can't get their heads around backing a 30-something-year-old to go buy a company. And one of the ingredients and one of the reasons for this panel is that team around the entrepreneur. And the reason I say that is because, as you alluded to, Pete, there are a couple people that are not on the stage today that were very critical to getting this deal across the line. That's Will and Nathan at Wellwords, who actually brought in Craig. David Kerr on the Australian side of LegalVision, who introduced me to Georgina. And then Tom McGee, who is our debt advisor, who is very deeply involved in the deal, and it wasn't easy to work with a bank on a cross Tasman deal, and so. But in response to your working capital question, this was a seller that originally bought the business that we were buying from him, and that wasn't the only acquisition he had done. He had somehow gone from a farmer, we actually need to clarify this story somehow, but he had gone from a farmer to buying a handful of businesses over the years and running them quite effectively. Even so, even with that experience, getting through the working capital discussion was difficult. There was a bit of a learning curve for him, and different expectations on either side of the deal. Part of my role, it was Craig, Will, Nathan, the seller's accountant that really drove the working capital conversation. My role was more working with Jason to help align on what's acceptable, what's not acceptable as far as gives and takes. Coming into a couple of the conversations with the seller myself to provide a bit of history and credibility and weight to our position on the working capital discussion. But it's very difficult. I think probably one of the more painful memories from the diligence phase, from Jason's perspective, was realizing that he actually probably had to pay more attention to the very, very messy inventory question than he wanted to, and it's a good thing. It's a good thing he did. There are a couple other stories in the EtA community on the Australian side where that inventory part of working capital really came to bite the entrepreneur in the ass later. And it's usually not ill intention on the part of the seller. It's just ignorance or bad systems, not knowing what's really in the warehouse. So really rolling up your sleeves with your advisors, but really honestly, mostly yourself as the entrepreneur, and figuring out the realities of the business is pretty important. So just having those discussions with Jason was my part of the game.
And did the seller and or their advisors know what working capital is?
They thought they did. Yeah, we learned that they didn't really, as is usually the case. We're actually, Stain is going through that right now with a deal that has a broker representing it, who originally thought, and the seller represented to us, that he understood what working capital was, but then he started asking for WIP in addition to the purchase price, and now he's talking about receivables. Wait, I just sold all those contracts. I should get paid for them over the next 6 months. And the broker is now going through a process of educating the seller on working capital. We did another deal where the seller was a certified accountant. Turns out he didn't know what working capital was either.
Those accountants, they can be the worst, right?
Yeah.
No, like working capital, unfortunately, in deals of this size is material to the deal. Like once you get bigger, like you can have massive deals with lots of working capital, but proportionately, like the swing factor, and it's just, unfortunately, really badly understood on the sell side. So hence another reason to make sure we've got kind of good people in the team. Right, so now sort of DD and completion. So through this process, so we negotiate a deal, and now we need to complete our DD and get through the completion phase. Georgina, in the DD phase, what are your kind of top hit points? Like if you're going to go through and diligence on the buy side, what are the 2 or 3 things that you want to take the closest look at?
Yeah, good question. Very transaction specific. But
well, for this one then.
Yeah, for this
use
one.
this example if
Yeah. So, I mean, at a really high level, there was a piece around sort of the ISO certifications is really important here. So, again, to the advisor point, is this so business critical that we actually need a specialist advisor in there to do DD, particularly on that piece? From the legal aspect, we were... I guess my one sort of comment here is that there's a real a patience that's required here. So the approach that you're going to take is very much a broad brush, DDQ that you're going to start off with, and then you start to work with obviously Jason, who's doing more of the operational side of things, getting to know the business, and you're working out through that kind of combined process where the key focus points are. The reason you're needing to find those key focus points is because you're never going to find a deal in this bracket that is risk-free. If you're finding a deal that's risk-free, we'd like to hear about it. You're also going to pay through the nose for it. So it's really, I think probably my main comment there would be making sure that you're working really closely with the searcher, who's the one that knows the business most intimately. As the advisor, you're going to have to get across that really, really quickly, much quicker than anyone else. And so they're going to be the best person to work out where the key kind of focus areas are. And to the risk point, then it's basically just a process of highlighting those risks to the client. and then working out how we mitigate them. And from a client perspective or a searcher perspective, you're having to understand, well, be very, very clear on your risk appetite and what are your deal breakers. Everything else, you are going to have to make concessions. You're going to have to make concessions the entire way through, and you're going to have to make quick decisions on those concessions as well if you're not going to tank the deal. So a sort of a broad brush, random, rambling sort of an answer, but hopefully that gets us there.
Well, I think it's one of those things where, like you're saying, it's every single deal is slightly different, but you need to be ready to identify where those key risk points are, because that's effectively the point of the document, right? Craig, like there's a lot of sort of thought and structuring that goes into making sure, particularly for this one that ended up being a share deal, is going to head in the right direction. What are you looking out for? Like you kind of do your work in the lead up, and then in some senses you're kind of handing over to the rest of the team to make sure that what you wanted to happen ends up happening in the document. So you're kind of then watching the team go through. What are you looking out for to make sure the idea you had in your mind that you want to crystallise at completion to manage all those risks from a tax perspective? What are you looking out for as the team is going through that process to make sure that they're kind of not missing anything?
So there's two key parts to kind of the work you're doing. There's obviously the due diligence part and sometimes, the tax structuring part. And that was, there were some good discussions that were had about that, given this was a trans-Tasman sort of deal and especially the debt piece and whether the debt was going to get pushed down to New Zealand at all or not, or whether it was going to stay in Australia. And so often a lot of structuring is done with trans-Tasman deals to, in some cases set up a bit of a holding company here to kind of absorb transaction costs and also to absorb debt so that you can do that in a tax efficient way. So coming back to kind of the due diligence piece, if I just make a couple of comments on that, I think really key to that work is scoping out what you're going to do at the outset pretty carefully. So it's kind of about what are you going to do and what are you not going to do. You really want to be focusing on the key risks for the business that you're dealing with and spending most of your time trying to look at those, because they're the things that will influence value, in my view. So with the Trans-Tasman business, there was key issues like transfer pricing that came up, a key sort of international tax risk issue that had to be managed. And then there was just a whole lot of additional work that had to be done just around just making sure that, compliance history was pretty robust, because the vendor in this case didn't really have a dedicated sort of finance team. They were reliant on their advisor a wee bit to help with kind of year-end related matters and stuff like that. And so, especially when you're going through that process of due diligence, trying to get detailed information that you're after to get some comfort on things was a bit of a challenge. I don't think this is kind of unique to this deal. This happens across every entrepreneurial deal where you just don't get the information that you want. And so, to take Georgina's point, every deal is not risk-free for that reason. So yeah, I think getting that scope defined, making sure you're focusing on those risks and having really good communication with the wider team around issues as they arise, and having good, robust management meetings and trying to bring them to the table to, get some clear answers. And often they have to bring their advisor along because they know nothing about tax specifically, which doesn't give you the greatest deal of comfort, but it hopefully with their advisor on board, you can pretty much get a clear steer on whether it's an issue they've looked at or not looked at, and so you can build that into your next part of the plan, which is looking once the deal's done and sort of your 100-day plan and what you might want to have to implement as part of that. So I think getting that tax structuring part is also a really important piece, just making sure that key aspects of that are well understood and factored into the decisions. Yeah.
Awesome. Thanks.
I just want to add that this could have been this was a unordinarily abnormally complex structure given the multinational structure for a search fund deal, and could have been abnormally stressful. But I just want to give kudos to Jason, who really took it all in stride, and he's sort of one of those calm, thoughtful leaders that is really well fit for a deal like this, and I think his employees are recognizing that as well. We had dinner with a handful of his key employees the other night, and they're clearly very excited to have this new ownership that is thoughtful about the future of the business. So a lot of credit to Jason. I don't want to say that, I don't want to give any impression that his team of advisors were responsible for this deal. It was 90% Jason.
So it's a good segue, because the question I was going to have for you is like, obviously there's a whole team of advisors, but one of your key roles is actually kind of pit crew for Jason, right? And how did you, you've answered one of the questions, given that kind of his generally calm demeanour is what's brought him through the day. But like Luke's comment earlier was, I got to day one of post-completion and I was tired. How did you kind of work amongst the team and with Jason to try and prep, the driver for the race on day one, given that day one's actually post-completion, not due diligence?
Yeah, so again, Jason has a very impressive background with an array of experiences, but one of those is in doing deals. He was an M&A advisor for a boutique advisory firm, and so he had some exposure to the larger end of town, doing some slightly larger deals, and so this wasn't his very first rodeo, but there were a lot of new elements to this deal that required some learning. And so to your point, Pete, it can be a lot of not only people, but balls to juggle for the searcher, particularly if they are doing this for the first time. I know that I remember that being one of the most stressful moments of my life, is because not only do you have these three people and the few additional advisors that I mentioned, but you have a cap table of 15 investors. You might have, I think we're going to get to that in a minute, you might have a gap and you're simultaneously trying to raise additional equity for that gap. You're juggling multiple lenders who are looking at this deal. You have a seller who's getting emotional. You might be talking to the employees of the company you're looking to buy who are confused about what's happening. Your mom doesn't know what you're doing. There are a lot of things happening in a concentrated period of time. And so my role is part therapist, but also just a partner that can take on some of that load throughout that chaotic period. We'll get to some of the equity raising stuff, but I certainly had a number of parallel processes going while Jason was focused on one thing, where I would interface with Georgina or Craig or the other people on the team. And we have a template for each deal in our Asana project management tool that has hundreds of items with links and best practices. And so just providing a structure and repeating prior history, learning from prior history, providing a bit of therapy throughout the process is what we hope to do.
Yeah, it's that comment, kind of the one that came out in the earlier session around just that general sense of, we've seen this before, it's okay. Like, that's really reassuring. Yeah. What we might actually do now is change tack and check to the audience for questions. Has anyone got any questions for the crew? And it can be from people in the know as well, if you want to really put them under the pump. But does anyone go, oh, there you go. See, I saw Luke smile and I was like, I reckon, yeah. Over to you.
Boom.
There's a... Yeah.
Yeah, look, I was going to say, James is sitting right next to you.
There's a lot of
Don't think you want to do an Aussie deal, because James is really reconsidering it. Yeah.
There is a lot of different ways that you can charge fees, and you know, effectively you can have a retainer with more at the upside if the deal's successful. In my experience, when it's coming to you know, engaging advisors, you want to make the process as tight and as fast as possible so that everyone's focused on getting a deal across the line. Now, I know that's often not feasible because you're dealing with the whims of the vendor and how they rock and roll on a few things, but the tighter you can keep that process, you know, the more you can control the fees and how they work. But I would just say there's a number of different ways that you can engage advisors to kind of, if you're going to put more risk on them, then hopefully there's more reward and upside at the end for them by just accepting a lower fee or a retainer just for some of the stuff they're doing.
Yeah, and I think to your comment, Craig, speed, it's all about speed. So I have deals that you've got a really motivated client, there's a commercial terms are agreed, they've got a motivated counterparty, things move quickly, the fees can be tiny given the value of the transaction. Equally, you can have our biggest pain point, a really low value transaction with really unsophisticated parties, and you just simply can't charge the time that you're spending on it. So I would say that we do take some risk on these things. The other piece as well, you know, often we would only charge at the end of a transaction. So we've already, you know, months long kind of fees that are being incurred. The reality is if the deal falls over and they do fall over, we're not going to charge the full whack. So we know that, you know, there's some risk there for us as well. I had one other point and it's completely escaped me.
I'll jump in. Some of the burden is on the searcher to not only to first find the lawyer or the advisor that is commercial on that front, that isn't gonna, like, we're doing small deals, right? We can't have all the bells and whistles when it comes to diligence. We worked with another firm one time that, goodness, it took 5 people to send one email, and when I've actually with a couple, I think one time your Australian counterparts showed up to a meeting with 4 or 5 people on the Zoom call, and I'm like, 3 of you don't need to be here. Please leave. And like, I'm not paying you for you know, thousands of dollars for this hour. So like you have to sort of take the reins somehow to some extent too. Yeah.
And I think that goes to the point around picking the advisors in the right space as well, because if you are working at that low to mid-market kind of M&A space, you don't want someone who's point scoring. You know, there's no space for that. Both advisors on both sides need to understand that actually you're working collaboratively here. It's not a you win, I win. Actually, we're trying to get to the same goal. How do we get there in a way that everybody's happy and comfortable with that outcome? As soon as you've got that attitude taken to the deal, then things get pretty smooth.
Yeah, down the front.
So my question is to the rest of the panel. So when you come to closing the deal, as the potential buyers, you are now involved emotionally in the business, and you probably now probably biased towards a positive outcome for the business. How do you deal with your advisors giving you sort of not a very negative perspective to things, but the advice bringing in a bit more risk than you were thinking of anticipating? That's the first question. And the second question is that, do you see your advisors as only guards for the risk, or there's some also value additional expectation that you expect from your advisors, besides just managing the risk?
I'll paraphrase that slightly to a deal fever question for Jake to answer, just in the interest of time. So how do you manage deal fever on the part of the entrepreneur?
You might want to ask Jason or any of the other searchers how and part of my role is to prevent, or not prevent, but manage deal fever, which over the course of the search, there's a pattern. Like, it's actually pretty high at the very beginning. The first the very beginning of the search, the first doable deal, the searcher tends to get really excited about and think that's the one. Then it falls over, and the bar raises, and then you're right during the deal phase, particularly if it's toward the end of the search and they start to feel like there's not going to be another chance to buy something when the search capital is running out. Then it can climb. And those can be some uncomfortable conversations, whether it's with me or whether it's with an investor. It tends to not be with the lawyer or the accountant that says this deal is not looking as attractive as we once thought it would be. It tends to be me asking more pointed questions. But you're right, I'm part of the entrepreneurial team too, and I'm not totally immune to that. The accountant that we use for a lot of the deals is pretty pointed and honest about what's good and what's not, and so we take that into account. There are also moments where we realize that we've lost something, and we therefore look for opportunities to make up ground, be it in the working capital negotiation or in the timing or in investor conversations. So I mean, I don't have a very clean answer to your question. Deal fever is real, and you just have to be aware of it. I don't think you can look to your lawyers or your tax advisors too much to help with that. You need an entrepreneurial partner to help hold account, and investors. Yeah.
Yeah, and that's one of the good things about having a diverse investor base is that you get that spectrum of views, right? And you want that tension. You want the person at one end saying, yeah, do it, and the other person saying, this is a terrible idea. And then you can start to triangulate where you might sit on that spectrum. So thank you. One more question.
Just a quick question, mainly. Jake, I'm interested, how do you keep your investors on that journey? You're going through all these ups and downs. You're managing all these different advisors. It's great the deal was one day and then you find something. How do you keep your investors kind of level-headed and all on the same page as you navigate due diligence?
Yeah, so you have few groups of investors. You have one group that has committed, if you're in a funded search, has written a check to fund the search, and that has done it many times before. You have another group that it didn't write a check during the search phase for whatever reason, but might be a gap investor if you have an equity gap at deal time, and then. Across both of those groups, you have people who are pretty brand new to the space. Those ones tend to be, to Jason's point earlier, the people who have a lot of experience investing in this asset class tend to be the most level-headed, understanding, patient, and receptive to the searcher's cadence of communication rather than sort of breathing down your neck. They want to be used when valuable to the searcher, particularly during the search phase when the capital at risk is small. Jason, I just actually published a blog post about how awesome Jason was at keeping investors apprised throughout the journey and building that relationship throughout the journey, not just with those who have written a check for you, but your potential gap investors. So the minimum requirement is a quarterly written update. But Jason, Kylie is very good about supplementing that with regular, friendly, update, transparent, vulnerable, honest phone calls with those investors on the cap table that want that are willing and eager to have those conversations.
Fantastic. Oh, sorry, Stan, we've run out of time. You can pick it up at lunch after this one. I'm going to try and keep sticking as much to the clock as I can. Please, quick round of applause for this panel. Thank you very much.